Hello, everyone, and welcome to Technology Tuesday. It is our first Tech Tuesday of 2023, so we are so excited that you were able to join us today. My name is Jennifer Darachuk. I am the marketing manager here at Out of the Box Technology, and I'll be serving as your moderator for today's presentation. So just a few housekeeping items. This session is being recorded. So you will receive a link to the recording following the session, either later today or first thing tomorrow morning. So you can go back and revisit any of the topics we covered today, share with your colleagues and friends, just have that as a resource for you. Additionally, we will have time for questions at the end of the presentation. So as we go through the material, feel free to use that chat box and send over any questions as they come to you. And then that way at the end, you're not kind of remembering what you were thinking of asking. Go ahead and just put those and we'll make sure to keep those in the queue to answer at the end of the session. We appreciate you joining us once again. This presentation is hosted by Out of the Box Technology. A little bit about us here at Out of the Box Technology. If you haven't joined us before, or maybe it has been a while, we are anything and everything QuickBooks. We have the elite status of Intuit QuickBooks Solution Provider Program, meaning that we really are the cream of the crop when it comes to QuickBooks service and solutions. So we have a whole team that works on the whole family of QuickBooks products and the automation products, third-party apps that integrate. We do data services, a whole slew of accounting services, and then training, integration, and support as it relates to all of those areas. So that's enough about us. I would like to learn a little bit about you, our audience. So we have our first poll question here that I'm going to launch. So if you could just take a moment and let us know which of the following best describes you. Are you a bookkeeper? Are you an accountant? Maybe you're a business owner, operations manager. And this is freeform, so if you wear multiple hats, you can go ahead and answer accordingly. So I'll go ahead and give that a couple more seconds to let everyone get a chance to answer. And it looks like a good portion, almost half of our audience today are business owners, and then about a third are bookkeepers, and another 25% are saying that they are an accountant in that role. So just kind of a good idea of where our audience is today. So thank you all for answering. I'm going to go ahead and close that poll and just share so we can see again a good mix of bookkeepers and business owners, about a third, and about a quarter accountants and operations managers. So thank you again for participating in that poll. Now I would like to introduce today's presenter, my colleague Brista Mayfield. She is an executive director of our accounting and data services team at Out of the Box Technology. She is a fantastic asset on our team and has a wealth of information as it pertains to bookkeeping, accounting, the similarities, the differences, and how this all applies. So with that, Brista, I'm going to hand things over to you to get started with this conversation about bookkeepers versus accountants or CPAs. I know we don't want to bundle them together because there are important differences, but just to get this conversation going. So Brista, take it away.
Awesome. Thank you, Jennifer. I'm very excited to bring you guys this content today to discuss the difference between bookkeepers and your accountants or your CPAs. So for me to start off with, we're going to look at bookkeeping versus accounting in general. And I have another poll question for you guys. Just a general thought for you. How do you know if your business is having a good year? Again, it's freeform, so you can select multiple options there, but what do you generally look at for how your business is having a good year, how you know that? Just something for you guys to think about as we go through this as well, just to get your thinking caps on.
Absolutely. Thank you, Brista. So we've got the results rolling in, and we're sitting at 94% of our audience is saying they review their financials. And another about half say looking at the bank account balances. So a little bit of a mix there. and a few people commenting based on how busy the service teams have been. So I know that you will kind of speak to what we should be looking at, what might give you a false positive, as we say these days, in looking at if your business is having a good year. So thank you to everyone for participating. I'll go ahead and close that and dive right in.
All right. So with that, we want to start out with 3 questions every business owner asks. And for those of you that are here as a business owner, I'm sure you have asked these at some point or another throughout the year, or every day. So how much money did I make? Where is that money? Is it sitting in your bank account? Is it sitting in maybe some assets that you've purchased? Is it sitting somewhere else? You know, where is that money that you have made? And how much will I owe in taxes? We are in full tax prep swing, so this seems more relevant right now, especially as we're getting years closed out, we're getting everything prepped for tax season, for those of you that close at the end of a calendar year. So with all 3 of those questions, your answers rely on good bookkeeping. So what do those practices look like, and how can bookkeeping help best prepare you for the answers to these 3 questions? Then your financial management with QuickBooks, we have, you know, your industry, what platforms are you using, what processes are you using for your industry specifically, how that ties into efficient and accurate bookkeeping. So it's, you know, it's a back and forth type process. Your processes will always tie into that efficient and accurate bookkeeping, and then vice versa, as well as your technology platforms. They are tying into QuickBooks. You know, how do those talk to each other, and how does that help with the bookkeeping? So as we look at this cycle here, you know, all of them work together, and having that efficient and accurate bookkeeping can help with how things are managed in QuickBooks, and then how things are managed in your own processes and in your technology platforms. So with that, we're going to look at what is bookkeeping versus accounting. So bookkeeping is the practice of organizing, recording, and summarizing that financial information in a systematic way. So bookkeeping, with that practice, it's recording of the entries that are coming in, whether it is, you know, recording as an expense, if it's coming through a bank feed, recording deposits, those types of things. And then accounting is the system of recording and summarizing your business and financial transactions, and then analyzing those. So bookkeeping, it's, you know, we're recording those transactions. Accounting, we're analyzing those results, and then also doing those adjusting and closing entries on the accounting side. So if we look at cement versus concrete, we have some people in the construction industry. So cement is an ingredient of concrete. We got to have one in order to produce the other. So accurate bookkeeping will help with accurate accounting practices. Then also with that, accounting and bookkeeping, like I mentioned before, we're recording. Bookkeeping is recording those financial transactions, posting debits and credits, preparing preliminary financial statements, processing payroll, paying bills, billing clients. You know, those month-end statements. We'll talk a little bit more about what your month-end would look like as a bookkeeper versus an accountant side of it. So with the bookkeeping, we're tracking, recording, organizing, making sure everything is there for the accountant to then come in behind and interpret and analyze all of those financial statements. So the bookkeeping then is zeroing in on that administrative side of the business. So not only are we recording and posting those transactions, but we also are taking that data and organizing it in a way so that we can easily reference later, or look at the data that is presented in your financial statements in an organized fashion. With the accounting side, preparing those adjusting entries, if there's any audits involved, the proper bookkeeping and organizing procedures when it does come to auditing, having all of that organized helps with that at the end of, you know, in that audit period. Filing tax returns, if you have a tax preparer and they're you know, filing those tax returns for you, having everything organized in your bookkeeping will help with that tax return and help with answering any of those questions that the CPA that's filing the taxes that they may have. Again, we are in that world right now. We're getting everything ready for taxes. And so your bookkeeping is a good reflection of how prepared are you for taxes. So have we kept up with those proper bookkeeping procedures? On the accounting side as well, you know, we're interpreting those results, and then it allows us to be a little bit more subjective as far as, you know, here's your data and here's where we can take this and make some decisions based on those results. The accountant is also doing the depreciation. They may do the depreciation and the bad debt entries, your accruals, deferred revenue, and any reversing entries that may need to happen. So a couple of buzzwords that we might see with bookkeepers versus accountants. So bookkeepers, we're compiling the information, we're organizing the information, we're selecting those accounts. The account is a place in the books used to record your business transactions. So, you know, was something a material that you're purchasing? Was it an income type of an account? So you're using those different accounts as you're categorizing transactions and compiling the data. For the accountant, you're using a ledger. So the ledger is like a checkbook register for those of us that remember the checkbooks back in the day where you're writing those, physically writing those things down. So your ledger is a register compiling those transactions and the collection of accounts used. So you may have subsidiary ledgers that have a little bit more detail. You might be looking at job costs, but the account is where the bookkeeper is placing those transactions as they're being recorded in the bank account. And then the ledger is, again, that check register. So just a couple of different words that you might hear in bookkeeping world versus accounting world that we might see. So then we look at our accounting periods and cycles. So your accounting period can be anywhere from a week, several weeks, quarter, year, monthly. We talked about a month-end close. So this cycle may look like a month-end close. Again, with taxes, we might be on the yearly cycle where we're looking at all of this. So your bookkeeper then is recording those individual transactions using those accounts, recording income, expenses, cost of goods, any extraordinary income, and then posting journal balances to the general ledger. So, you know, may not necessarily come out of the bank account, but there's other journals that need to happen in order to post those transactions to an account. Then we look at, you know, the month-end type process where we're reviewing those entries, reviewing the bank account information, reviewing the reconciliation amounts that comes on your bank statement. So doing that month-end, the bookkeeper is doing that month-end review in order to prepare those preliminary reports. So whether that looks like, you know, a weekly cycle, monthly cycle, quarterly, or yearly, we're preparing those preliminary reports to then report back to you, the business owner, so that you can, you know, take a look and make business decisions based on those. You may choose to prepare periodic financial statements to intermittently assess those, as mentioned before. You may also be on a fiscal year, so where the bookkeeper is recording the transactions, posting those balances to the general ledger, preparing those reports. This may look a little different if you've shifted then to a fiscal year. And then the accountant then at the end of the year, when you're getting ready for taxes, whether that is fiscal year, calendar year, however you're doing that, the accountant then comes in and posts those adjusting and closing entries as mentioned before. So is it deferred revenue? Is it bad debt? Is it depreciation? You know, they're posting those entries. And then once that is all finalized, then the accountant or your tax preparer is preparing those financial statements so we can then do tax reporting. So all of that works together in a cycle, whatever, you know, whatever period you're looking at. You may have a tighter cycle where you're doing a lot more of the accountant being involved on a monthly basis or a quarterly basis. But those bookkeeping procedures that you're following can be helpful in tightening up this cycle and making this cycle as easy and as efficient as possible. There might be some items that you reconcile not necessarily monthly, but it's a good idea to watch those balances each month to make sure that it is tying out to a running balance that you're keeping.
Brista, thank you so much. Before we move into our next section and topic, we did have a question. If you could kind of talk a little bit to what you mean by preparing and adjusting entry, and just dive into that just for a minute to answer some questions.
Sure. So when I'm talking about an adjusting entry, that may be, you're paying a loan balance down, and your loan, when you post that loan payment, if we need to recognize interest in that adjusting entry, you can do it that way. If there's any adjusting to accounts receivable or accounts payable that needs to happen at the end of the month due to a statement that you've received, anything like that where you're adjusting the account balances, that's what we refer to as the adjusting entry.
Great, thank you so much.
Mm-hmm. So we talked about bookkeeping versus accounting. So now we're going to look at the benefits of accurate bookkeeping. So, if you're a bookkeeper here, what practices we would want to see for accurate bookkeeping. If you're a business owner, what to look for in that accurate bookkeeping. So with this here, you're required to provide financial information to outside advisors and coaches. So if you've got proper bookkeeping, and you want to provide that financial information, you want to have confidence in what you're providing to outside advisors and coaches. If your advisors and coaches are looking at your financials, it helps you make those decisions to build your business or to sell your business, open a second location, getting a loan. You want to have confidence in those financials that you're presenting for business loan purposes, protecting your investment. You, the business owner, you've put some money into the business, and so you want to know that it is protected and you do have accurate financials. Again, tax returns. So when we get ready to file taxes, is what you're providing the preparer accurate? Is there follow-up questions that need to happen? Is there cleanup that needs to happen? So maybe we look at those procedures and analyze what can we do to be more accurate in our bookkeeping. Because, as we all know, when we provide stuff to the CPA or to your tax preparer, it's nice to know that you're turning something over that's easy for them to interpret and easy for them to determine those tax returns. All right, so with accurate bookkeeping, we talked about being organized, and you have receipts, you have purchases, you have all those types of things. So how are things being organized in your business? Whether it looks like, how am I categorizing those things as they come through the bank account? Is it income? Is it wages? Is it taxes? And when you look at financial reports, we can see everything easily organized in a well-presented financial statement, but also those records. And are you keeping your receipts digitally? Are you keeping them physically? What does that look like as well? Being able to keep those types of things organized. When we look at the questions, how much money did I make? Where is it? How much will I owe in taxes? These types of things here are all benefits of accurate bookkeeping. Then also our ability to make informed decisions. We talked about the business coach, outside investors. When we're looking at your financials, what types of decisions do you need to make for your business to help grow the business? But those proper and accurate bookkeeping practices gives you the ability to do that with confidence. So then we also have the accurate indicators of measurable success. So we're creating those financial statements, creating those preliminary financial statements on the bookkeeping side, but you want to have accurate indicators of that success. So if we're looking at trended reporting, do we have, are we trending in the right way, or do we need to maybe make adjustments somewhere else that we can continue to increase and continue to see that line go up as we're looking at profitability or percentages? You're always looking at that kind of stuff to improve. So when we're looking at trended reports, is that allowing us to make those decisions? And again, proper bookkeeping will help you do that. Financial statements that can help with decision making. So when we're looking at balance sheets, income statements, cash flow statements, proper bookkeeping procedures, categorizing things properly in the right accounts. So then that way, when you're looking at your balance sheet, your assets, liabilities, and equity, is it all in the proper categorization or in the proper account? Your income statement, what is my income versus cost of goods versus expenses? How does that compare? And you look at the income statement on a trended basis, like I said before, can help you make those informed decisions. So we're better prepared for tax season. We're going to keep mentioning this, especially for this time of year. We're better prepared for tax season, and having everything, like I said, in line helps us get ready for that. The documentation that you might have to provide to the federal government, or you must provide to the federal government. So when we talk about bookkeeping, not only is it recording the transactions properly, but we talk about that organization. So being able to provide these types of things when asked, we've got everything ready and available. We can go find it quickly. We know where to find it. We have those statements. We are in compliance with those tax regulations. Do we have any cash? Do we have cash flow reports? Can we provide those? So the benefits of accurate bookkeeping all tie back to that organization. Are we compiling the data properly, recording properly? Are we double checking monthly, quarterly? So then that way, when we do come to that end of the year, we've got everything buttoned up and tied with a pretty little bow. And it makes it just a little bit easier when it comes time to provide any information that we may be asked for. So then when we talk about best practices of bookkeeping, there are several things that we want to take a look at when we talk about that. So we're going to start with your chart of accounts. So using the appropriate chart of accounts for your industry. The chart of accounts is a listing of your assets, your liabilities, equity, income, and expense categories. So if we look at your chart of accounts, how clean your chart of accounts is going to determine how clean your financial reports look. So if if we have a messy chart of accounts, we might have a messy looking financial statement. And so the chart of accounts is what bookkeepers are using to categorize things. So maybe we need to revisit, what does my chart of accounts look like? How can I clean this up? How can I make this a little bit more efficient for my bookkeeper? Or if we're in the situation of business owners doing the bookkeeping and we want to turn it over to a bookkeeper, what am I turning over to them? Is it clean? Is it maybe a little messy and we need to tidy it up a little bit? That's where, out of the box, where we can be helpful to you in looking at that. How can we help make this a little bit more efficient? And then specific to your industry. So, we've got multiple ways to present your data as far as in your industry. So what is best for where you are at? Which accounts are right for your business? So we would want to have your set of accounts created for your business needs. The tax classification of your business too will determine some of those equity accounts or those asset liability accounts based on your tax classification. So we want to make sure that that's set up correctly for you as well. And so we also want to make sure with the chart of accounts, they're chosen in accordance with the tax authority. So do we have federal taxes? Do we have state taxes, local taxes? And then we look at the organization of your accounts. Do we have items in the proper place? Do you have assets in the asset category, or maybe do we have something that should be a liability? Your equity accounts, we take a look at that. Income, is it truly income type of accounts? And then where it gets a little hairy is the cost of goods and expenses. What is the difference between the two, and how can we best present that information so that when you look at financial statements, it is going to be presented in a good, clean way. And then we talk about using standardized account numbers. So generally with the account numbers, it's a logical sequence where without the numbers, it'll be organized by account type, then alphabetically. If we add account numbers, then you can have your account type, but then organized numerically. And you would use a logical sequence of numbers and assign them to your chart of accounts. And it'll help you create efficiencies in your reporting. So if we number your expenses maybe a little bit differently so that it's organized 1 through 5, which one do you use the most? And then you use increasing numbers, and you can change up how that's organized on your financial statement based on the numerical order of each account type. So in general, whether you use hundreds, you use thousands, you use tens of thousands for your number, in general, ones would be your asset type of account. So money that you have, or assets or equipment that you've purchased, or vehicles that you have. So that's your ones. Twos are generally your liability, whether that's 200, 2,000, 20,000, whatever numbering system you're using. So twos are the liabilities, money you owe people, loans, credit cards, any liabilities as far as payroll taxes or taxes that you may owe later. Threes are going to be your equity. Fours are going to be your income accounts. Fives are generally cost of goods sold. Sixes are generally overhead expenses. Sevens are your extraordinary income. Eights are your extraordinary expenses. That's general. So again, it's a logical sequence of numbers. So however you see fit to number your accounts. And like I said, it does help with organization. Now, if you, the business owner, when you're looking at financial statements, you'd rather see it without the numbers. That function is easily turned off, as well as it is easily turned back on for those of you that are preparing those financial statements, whether it's in the bookkeeping capacity or the accountant tax preparer capacity. Easy to turn on, easy to turn off, depending on what you would like to see. Now, one thing to note, if you have reordered your chart of accounts within QuickBooks Desktop, for example, and you've actually reordered that chart of accounts, which then turns off the ability for it to be organized by alphabetically or numerically, you can just click resort and it'll resort the list. So if you have somehow gotten yourself in that situation, you can click resort and it'll actually resort that list for you. So chart of accounts is important. How clean is your chart of accounts? Or maybe on the flip side, how messy is it looking? We can definitely step in and help you with that, because clean chart of accounts helps with efficient bookkeeping. So then along with that, we're going to talk about balancing your sales and cash receipts daily. So daily is when you have a lot going on in your front end system. Front end system is, the Service Titans, the estimating softwares, those types of things where you might be tracking what you're estimating to the customers, what you're invoicing, what payments are you collecting in your front end system, so outside of QuickBooks. And then that information, if it is able to sync into QuickBooks, and you have a lot going on in that front end software, doing this, balancing and recording those sales and cash receipts on a daily basis, while it does seem daunting to do this daily, or inconvenient maybe to do it daily, when you do this, then the end of the month doesn't seem as large of a task. So it's less of a headache. You don't feel as overwhelmed at the end of the month when there's so much to get done. If you have done this, you've balanced your sales and cash receipts on a daily basis, or you've done a sync. If it's a manual sync from your front end system into QuickBooks. You're able to balance this on a daily basis. You may even identify things as far as, oh, I collected this payment, but why is this not in my bank account yet? If you've collected a check and you thought you deposited it, it helps you identify those things as well. Or, well, I know this, you're looking at your AR report. I know this customer paid. Where is that payment? Maybe I need to record that payment. Or you see the deposit in your bank account and we didn't record the payment. So there's a lot of pros to doing this daily. It helps you quickly identify those things that may need to be revisited. Whereas if you're looking at it weekly or monthly, you may not remember what had happened prior to that day, because we're all in crazy land sometimes where we have so much going on, it's hard to remember. So doing that daily is suggested, and I promise it'll work better daily rather than weekly or monthly. Then we look at reconciling your bank account. So we all get statements, we all get those notifications at the end of your billing cycle, whether that is your bank account and they close at the end of the month, or it's your credit card or loan accounts and they close their cycles mid-month or on an off day. So reconciling those accounts, your bank account, credit cards, loans, even, you can do this, but do this with the statement that you receive from your bank. It's easy to take a look at, oh, QuickBooks says my balance is X, my bank says my balance is X, that's fine, okay, we're good, we're moving on. When you reconcile your bank account according to the statement that you get from your bank, it helps you not only balance that, but also identify, do we have something that I've duplicated? Do we have a deposit I'm missing? Do we have deposit that's duplicated? Do we have expenses or bill payments that might be recorded that didn't clear until the next month? And so your balance, especially at the end of the year, where we have, we write checks in December, but they may not cash until January. And yes, your bank account balances, but is it a true balance as of the end of the year? So always tying out to those statements at the end of that closing date is important to identify those things, even if the bank balance matches to your QuickBooks balance. So the other item at the end of the year that we're looking at, do you have any deposits that are in transit? Do you collect credit cards and there's a delay in the deposit to your bank account? So is that the only thing that hasn't deposited as of 12/31 or the end of your fiscal year? Analyzing that item as well. And then any uncashed checks. Did I write a check to somebody 3 or 4 months ago and they haven't cashed it yet? Maybe I need to follow up with that person or follow up with that company and see where that is and then depositing it, so then that way it can clear your register. So just make sure that you are using the documents provided from your bank, from your credit card. And then we talked about those, we had the question about adjusting entries for the loans. So does your loan balance match the balance from the statement, not just an amortization schedule that we've created? We want to make sure we're tying it back to the statement provided from that company. Now, sometimes we may not have online access and we have to wait for those paper statements. So there's a little bit of a delay in tying that out, but if we're talking about, taxes and tying everything out at the end of the year, that may take a little bit to receive those paper statements, but it's, as long as we're reconciling those to the paper statements, it's always helpful, a great practice to have. And then we look at the monthly cycles as well. This is also a step in that process for the monthly cycle that we've talked about. And then another thing to really think about when we're talking about month end, year end, tying out account balances is those receivables and the payables. So when we refer back to the cash receipts, reconciling those sales and cash receipts daily. If we're doing this daily and we're identifying those things that maybe we have a deposit that I'm missing or a check that I haven't deposited, maybe we see a customer balance on the accounts receivable that I know I collected the payment for, so did I record that in my front end system? Or if you're using QuickBooks to invoice and to collect payment, what step did I miss in that process? Watching those accounts receivables closely so that at the end of the year, we don't have huge balances in the 91 plus column when you look at your accounts receivables report. You don't have huge balances there that then we have to go back and retrack. Did we maybe record a deposit as sales instead of matching it to a payment that came from our front end system or a payment that we recorded in QuickBooks? So watching that accounts receivables report is a great double check for that front end system. If you're using a front end system, does that front end accounts receivable report match what we have in QuickBooks? Again, great tie out. And if you're a bookkeeper here on this, on this presentation today, this is a great system to have in place to double check that. Or if you're a bookkeeper here and you inherited maybe an accounts receivable that has a lot in that 90 plus column that we know has been paid, reach out to us. We can definitely help and analyze that balance and help you fix those balances that might be old but not correct. If you're an owner in the room and you look at an AR report, maybe that's a question that we have at the end of the month. Did we review the AR report and are these balances accurate? Or you're looking at it and you know that certain balances are cleared out, or it's good to look at it from both sides, the bookkeeper standpoint and the owner standpoint. How come to an agreement as to how you both want to look at it, and make that part of your month-end process if it's not already. Same thing with your bills. So paying your bills on time, having a good process for what does your bill payment process look like. Do we have a certain day of the week that we're paying these, and that's the understood procedure? Do we have a certain way of tracking anything that's outstanding, or maybe we need to push things a little bit closer to the deadline rather than paying them right away just for cash flow purposes? But paying your bills on time, whether that's right away when you receive the bill, or maybe we push it closer to the due date, but we look at getting that paid on time. And then on the flip side, looking at your accounts payable. Some of those front end systems may have that type. You're tracking your payables through that front end system, or we're doing everything through QuickBooks and we're doing payables through QuickBooks, or we're just paying bills, paying bills as they come through the door, and we don't really have accounts payable. But on a bigger scale, if you're tracking those bills that need to be paid, then watching that closely to make sure that we, again, don't have anything in that 91 and over column that we know we've paid, or we're having that accounts payable and reviewing that accounts payable summary. We can look at, okay, did I pay the bill? Yes. Did I record the expense as it came out of the bank account? Did I record it as an expense, or did I match it to a bill payment that I did, or did I create the bill payment that I did? So analyzing that accounts payable is as important as that accounts receivable, because we want to make sure we're paying everything on time. On the bookkeeper side, we know when we provide the AP report to the owner, we know it's accurate. So making sure we've got a system in place for that, and paying everything on time. You, the owner, if you want to, you're pulling an AP report, you've signed the checks for certain bill payments, it's a good double check. Some of the things that we look at as far as duties. So, your owner is still signing the checks. The bookkeeper may be printing the checks, but the owner is still signing the checks. So we'll talk about that in a little bit as far as separation of duties and what does that look like. But, specifically to the accounts payable side, but just always keeping your eyes on those reports and making sure those are accurate, finding a good time, usually at the end of the month, to analyze those types of things too, and those types of reports. Okay, and then we talk about reconciling your inventory. So some of you may not have inventory. It's a very service-based business, so we aren't keeping anything on the trucks or in the warehouse. But if you are reconciling that inventory, depending on how you are tracking, is also a good practice to have in place. So again, we look at maybe it's month end, maybe it's year end that we're tying this out and taking a look at the inventory counts versus what we have on the books. So there's two different ways that we can track inventory. We've got the perpetual type of recording. So we are keeping track of every purchase and every sale of every item. So, and that is done within the accounting software within QuickBooks or within your front end system. The periodic way of tracking your inventory is a number on the balance sheet. And we might be tracking it on a spreadsheet. We might be tracking it just with a year-end count. So with the periodic, it's an easy and quick way to track your inventory, but it's only as accurate as often as you do the count. So if you're doing a count at the end of every month, we've got an adjustment every month, great. Your inventory, if you're tracking it periodically, is going to be as accurate, as you can keep it throughout the year, each month. But if you do a year-end count at the end of the year, then you've got that big adjustment at the end of the year. So again, periodic is just going to be, it's an easier way to do it, quicker way to keep track of your inventory, but it's only as accurate as often as you count. Now, the perpetual way of tracking inventory, while it is accurate, it is very, can be time consuming, and it can be harder to correct because you're tracking it within that software. So, if you're looking at reconciling your inventory, which way you would rather use to track your inventory, however you're doing it, there's pros and cons of each of them. So that's another, maybe it's a monthly line item that you reconcile back to what you have in stock. Maybe it's something that you do at the end of the year. That's, again, something you, the business owner, and you, the bookkeeper, would have to come to an agreement on as far as how often you're going to do that reconciliation of what you have in stock. And then when we come to the end of the year, we're done with the reconciling all these statements and double checking the balances and looking at loan balances, inventory balances. We've done everything. You've provided it to your preparer, taxes are filed and everything. You want to make sure that you don't have any entries affecting that prior period once everything's done. So our suggestion is for you to close your books. So within your system, whether it is desktop or QuickBooks Online, there is a way to turn on that closing your books feature. You'd set a closing date, choose a password, and only certain people have that password in order to override any other entries in that prior period that need to be made. When you're setting your password, choose something that you'll remember and don't lose it. And then just make sure you know who has access to that password. One thing to watch out for in this regard when you're closing your books is how, if it will affect your front end system. So if we do a sync in the future and we've closed the books as of the end of the year, and there might be something outstanding from prior year, it may not allow it to sync. So double check with your front end software that you're using to see if it does, closing your books does affect that front end. So while this is a great practice to have, so you don't have any adjustments in the prior period, you just want to double check on that, how that syncs with your front end system. So we want to make sure that we are maintaining those accurate and complete records. And going back to the month end, so we keep going through we keep referring back to the month end or year end or excuse me, or preparing for taxes. So maintaining that throughout the year. You, the bookkeeper, we're maintaining those accurate and complete records throughout the year. You, the owner, what involvement do you have in making sure that those are correct? That's something that you, the business owner, may want to refer back to. What are our processes that we have in place to make sure that everything is accurate and complete? Excuse me. And then keeping everything current. Are we bringing in bank transactions monthly? Are we bringing in bank transactions daily? Are we bringing them in weekly? What does that look like? What does current mean? If you're setting those processes in place, current to you, the owner, may mean the prior month. Current to you, the owner, may mean, do we have everything in through the prior day? And that's, again, something that you would have a conversation with with your bookkeeper to make sure that you both understand what current, when we're keeping our general ledger current, what does that mean? Monthly close processes, what does that mean to help keep everything current? Planning for taxes throughout the year. I've mentioned it several times, and keeping everything current helps us plan for taxes throughout the year, but that may look a little different based on do we need to salaries or draws, what do I need to refer back to my CPA on for those types of tax preparation procedures that we need to make as you, the owner. Keeping your personal and business finances separate. So we're all human. We might have, you, the owner, might have a personal card and a business card next to each other in your wallet. But we might accidentally swipe the card. But doing our best to keep everything separate as far as what's personal and what's business, that will, the bookkeeper, then we won't ask as much as far as, hey, was this a personal item or was this a business item? And having to go back and forth and keep that line of communication going as far as what's personal, what's business. If we can keep those separate, that definitely helps with the bookkeeper doing the tracking, but then also you, the business owner, to make sure that you have accurate account balances based on what is actually for the business. And then if we look at moving from manual to digital bookkeeping, more and more, everything is digital, right? And so we're trying to move from manual. So do we have paper copies of bills? Do we have paper copies of receipts? Do we have, are we still keeping a check register? Moving from that very physical type of a bookkeeping manual into digital, automated type bookkeeping, where we need to make a staggered approach if that's something that you do need to switch to. Doing everything all at once probably isn't the best way to go. Doing little steps. Okay, first we're gonna digitize all of our receipts. How are we gonna keep that digitally? Then maybe we look at switching from a paper printed bill, somebody puts their signature on it, then we pass it to the person making the payment, and then very much a paper step approach to signify where it is in the process. Maybe we look at, okay, how do we put that digitally? Or how can we automate the bills that we know we have to pay every month? Do we need to set up maybe recurring transactions, but within QuickBooks, but not everything would be done all at once. We take a systematic approach to moving from everything being manually done to digital and automated, which allows everybody to familiarize themselves with the process, or with a new bookkeeping software. If you're moving from check registers to QBO, what training do you need to provide for those new processes in place? Do we have everything written down? Do we have SOPs? Those types of things. So if we're making a move like this, where we need to move from a manual process to digital or to automated, that's again where we, out of the box, we can step in and help take a look at your current processes and maybe help you become more efficient as it relates to how things are being tracked within QuickBooks. And then I talked about this a little bit before, but we talk about the separation of duties. So you don't have, one person doesn't have complete control over everything. So you, the owner, if you have a signature stamp, and that's how you stamp your checks, or how you sign your checks, or how you sign paperwork, or whatever you're using that signature stamp for, it is somewhere where you always know where it is. It is not lying around. It's not on your desk. It's in a nice little safe secret drawer in your desk, so that it's only used when it's being used. We go back to the payable process. So the person receiving the bills may not necessarily be the same person that's processing and paying the bills, which may not be the same person that is tracking the expenses and reconciling the bank accounts each month. You've got different people in place to make sure that the money that was being sent out is actually the money being sent out to those appropriate vendors. Same thing on the money coming in. If I know, the person receiving the checks may not necessarily be the same person that's recording the deposits in the bank account, and then again, the same person that's reconciling those bank accounts at the end of the month. Keeping those duties separate is a good way to decrease the risk, but then also you, the owner, having review and control of things such as those bank statements. Okay, well, here's my bank statement, here's all the deposits, here's all the expenses. Something may look off, maybe I need to look into it. Those reviews and controls, those copies of the checks as well. You, the owner, reviewing the copies of the checks. What's being written out of my bank account on those checks? Most banks will have those images on your bank statements, so you can easily review those. So it's another good just separation of duties. Who is in charge of what part of the process? We don't have one person in control of everything. Same thing with access to your accounting software, where it may not just be a blanket admin access that you can click. Maybe we set up, okay, well, this person only needs accounts payable access, so I'm going to make sure they only have accounts payable access, or accounts receivable, or purchasing. Whatever that user role may look like, do we have that designated for each of the users that I need on my accounting software? And then when we look at cash versus accrual, so two different ways of looking at your reporting. Cash is when you look at money in, money out. So when the money is actually received or when the money is actually being paid out to vendors. So accounts receivable and accounts payable aren't included in reporting like this because it is money in, money out. Accrual is where you're recognizing the revenue when work is completed, not necessarily when it's collected, but when it is completed. And the expense is recognized when the costs are incurred from your vendors, not necessarily when you actually pay it. So accrual, when you're looking at your reporting on accrual from a business owner standpoint, and you're looking at it, maybe monthly, you'd be able to see, okay, what jobs did I finish? What expenses did I incur? And then everything, all the other things that kind of fall in with it. And that gives you a good month end number. Whereas with cash, if you're looking at it on a cash basis, what money did I receive in my account? What money did I spend out of my account? And then that gives you a bottom line. So most businesses should run on the accrual basis, where you're looking at that throughout the year. Now, when you get ready to file taxes, cash basis is the most commonly used type of reporting for taxes. But generally, if you want to look at how much money did I make and where is it, you want to look at it on an accrual basis. And then how much do I owe for taxes? Then we look at it on a cash basis. Okay. So then if we look at do's and don'ts of these practices and accurate bookkeeping procedures. So if you're looking at maybe moving somebody in one role into a bookkeeper role, don't assume that everybody knows proper bookkeeping procedures or just knows how to use QuickBooks. There might be training involved that you need to provide. You, the business owner, need to provide for your office manager if you want to move them into that role. Are they, wired that way? Some people may move into that role easily and can look at the training and use that and develop into the role of the bookkeeper easily, but be prepared to provide the training. And that's where out of the box comes in. We can help provide that training. We can help look at your books before hiring a bookkeeper. Do we need to help clean up? Do we need to help some maybe procedures, processes that you have in place for bookkeeping? Do we need to make those more efficient? So just be prepared to provide training for anybody that you're bringing into that bookkeeping role if they don't have prior experience.
All right, Brista, thank you so much. This was all really excellent information. And as our business owners, office managers, bookkeepers, accountants, the whole mix of audience that we have, they might be thinking the same, wow, that is a lot. So we are here to help. And how can out of the box technology step in and help you? Well, we are here to be your partner in bookkeeping. We can be here as often as you need, as little as you need. Our team of experts really has a range of skills that we can come alongside of you for the day-to-day. We can do some of those monthly, cleanups or health checks, or take a look on a monthly basis, a quarterly basis, or maybe at the end of the year, you're just like, I need you to dive in and get this cleaned up before I push this over to my CPA. So that's really where we can step in. We can take a look at your chart of accounts and see, is it messy? What does that mean to me that my chart of accounts is messy? We can take a look and let you know. How does this information apply to various businesses? Of course, there's a few areas, Brista, that you dove in a little bit, but more of it was on a general scale. So how can I tailor this to a nonprofit? How can I tailor this to the construction industry? What is broad and what needs to be specific? So like I said, that's where we can partner with you. We can do a consultation and just take a look and see what you might need. And if you start off thinking, nope, I only need you every 6 months, and then you come back a month later and think, no, we need to change this up. We can be flexible with you to make the best solution for your business. So with that, Brista, did you have anything else, kind of how out of the box can help? And then we do have 1 or 2 questions we might have time for here as we approach the top of the hour.
Sure. I think, Jennifer, you hit it nail on the head with how we can come alongside you and help. So I can answer any questions that we have. Since we have a couple minutes.
Perfect. So I know there are a few questions coming in about pricing and what that looks like. So what I would definitely suggest, it really depends on the scope of the work that we would do. Of course, I don't even think I could name a range. It just really depends on what we're doing. So I would just start with giving us a call and having a consultation and see what it is that you need. And then we can best kind of quote out what that project would look like in terms of cost. So there's a couple different packages that you could potentially work out with our business development team to work with a service member. So I would, if you're interested, if you want to talk more, definitely give us a call. I'll skip forward to our contact information. You can send us an email, call directly, or jump onto the website. We have live chat, or you can fill out a form there. So let's see. I have a question here, Brista. Which will help with the knowledge of letting an owner know if it's enough funds for bills? Let me see if there's a reference to that question. Maybe which area of their financials will let them know if they have enough to cover their bills?
Yeah, so if we're looking at covering your bills on a monthly basis, finding that break-even point, and we didn't discuss that today, but finding, how much do I need to make in sales to cover my bills, knowing what that break-even point is a good place to go, rather than just looking at a bank balance versus how much do I have on my credit card, how much more can I charge on my credit card? You can only do that for so long until you've gotten yourself backed into a corner. But so maybe we take a step back and look at, okay, what do I actually need to sell in order to cover all of those costs and all of those bills?
Sure. I think too, yeah, our audience member clarified a little bit. Is that a role of a bookkeeper or of a CPA?
When you're looking at something like that, I would look more to the role of your accountant or your CPA. The bookkeeper's preparing that information, and then your accountant then would be taking that and analyzing it for you and, getting you to that break-even point. How much do I have for my bills? So.
Thank you. And I think that is pretty much all of the questions. Like I said, there was a couple about prices or fees, kind of how that works with out of the box. So we can also send some information, or like I said, if you give us a call, they'll definitely be able to give you some more specifics based on what you're looking for. So Brista, in the respect of time for everyone here, we've got 1 more minute. So thank you so much for diving into this information today. I know it was a lot. Again, everyone will be getting a copy of, a link to the recording of this presentation. And so you can kind of go back and watch it back a little bit. And next week, we have another webinar. We are bringing on our partners, Avalara, and they're going to talk about, we talked a lot about tax a little bit today. So they're going to go over the 2023 sales tax law changes. They'll dive in state by state, what things are happening this year. So definitely you don't want to miss out on that. Even if you can't make it for the live presentation, if you register, you will get a link to the recording. So a great resource there. And I do see, again, related to tax, a couple questions coming in about if we do tax filings. We do not file taxes, but we can do cleanup work and some prep for taxes, but we don't file taxes. Brista, is that an accurate statement?
Yes, that is correct.
Perfect. All right. So again, thank you all for joining us today. We really appreciate you taking an hour. Maybe it was a little lunch and learn for you, or a good way to start your day, depending on where you are, East Coast, West Coast, or somewhere in between. So thank you so much, Brista. Thank you. And we hope to see you all again soon.
Thank you, everybody.